Welcome back to Alpha Recap, your after-hours digest of the big sector moves and news heads up. Today we're unpacking a busy holiday weekend of headlines. Energy and materials pushed forward, crypto hit another rough patch, AI kept tech in the conversation, and policy and tariff noise showed up across sectors. As always, if you have questions, you can reach us at stockalpha.ai.
Nice to be here. Good Friday had a lot to chew on, even though US markets were closed. So we're going to walk through what the news flow implied for each sector and why that mattered when trading resumed.
Exactly. Quick note, everything we talk about happened before markets opened again. So we'll be referring to what we saw and what headline momentum suggested, not live trading.
Right. And the first big theme was energy. Oil headlines were the loudest story over the holiday.
Yeah, and the pressure came from geopolitics around the Strait of Hormuz. Headlines briefly showed crude trading above $110 a barrel, which pushed a clear energy narrative. Producers and midstream names got a near-term tailwind, while higher fuel costs looked like a headwind for airlines and consumer-facing businesses.
So what really stands out here is how that one number rippled through other sectors. Higher oil can lift energy cash flows, but squeeze margins for retailers and logistics-heavy companies.
And renewables weren't ignored. There was also project financing and storage news that supported parts of clean energy. So it wasn't all black gold. It was a bifurcated energy story. Traditional producers helping earnings and renewables drawing capital for growth.
Moving to materials. There was a lot of constructive flow there too. Final investment decisions and streaming deals cropped up. Iron ore output looked stronger, and investors were talking about critical minerals like tungsten and silica.
That's important because when you have FIDs and project-level financing, you get multi-year cash flow visibility. It's one thing to talk about demand. It's another to see financing and capacity expansion actually happen. Those moves can lift sentiment across mining and materials names.
Totally. And tech was selective. AI product launches and hiring momentum showed up, but there were also data sourcing and privacy questions. So positive headlines, but with caveats.
Yeah, that tracks. AI continues to be a multiplier. Cloud providers, software with subscription economics, and some chip suppliers were getting credit for that. But listeners, and I want to underscore this, data governance and energy use for data centers are real cost and reputational issues.
Let's pause for a quick reaction. Big move on oil. Big move on AI. Big move on crypto. Short reactions.
Crypto took a beating.
Hacks and liquidations. Messy.
Footwear weakness. Interesting signal.
Okay, on crypto. Structurally important announcements and operational stress coexisted. Charles Schwab announced plans to offer direct Bitcoin and Ether trading, which is big for institutional access, but headline flow was dominated by hacks, fund outflows, and minor liquidations over the weekend.
Right, and that's a classic juxtaposition. Long-term distribution channels versus short-term liquidity issues. In plain English, institutions can help adoption, but when custody and minor balance sheets are stressed, prices are governed by who needs to sell first.
Which is why one of the action items we'll emphasize is tracking liquidity indicators, stablecoin flows, minor reports, and exchange custody statements. Not just the headlines shouting about adoption.
Totally. Now, consumer and retail had a rough stretch in the headlines too. Mixed merchandising signals, weaker categories like footwear, rising logistics and fuel costs, and retailer fees. Amazon's seller surcharge of 3.5% made headlines. All of that tightened the narrative on margins.
Retailers with pricing power were in a better spot, but otherwise it looked like a squeeze. Stress test your consumer models for higher transport and fuel costs, basically.
Before we move on, quick crosstalk. Tariff showed up as an operational risk. New tariff adjustments were scheduled and could affect manufacturers and retailers starting early next week.
Right, and tariff moves can be the sort of thing that shows up as a margin drag very quickly. If inputs get more expensive overnight, companies without supply flexibility feel it first.
Quick, short reaction segment.
Tariffs are margin spoilers. Okay, let's walk through the most significant single moves and why each one mattered.
First, oil and the Strait of Hormuz. We already mentioned the number, but the implication was broad inflation pressure and immediate cost shocks for transport-heavy sectors. It also improved near-term margins for energy producers and midstream infrastructure.
Second, materials and mining, project-level financing and FIDs. Those are the kind of corporate steps that change multi-year cash flow assumptions. It wasn't just talk. Deals were getting done.
Third, technology and AI. Product rollouts continued, but data sourcing and energy use questions created a noisy backdrop. That means AI was still a growth story, but it came with episodic reputational and compliance risk.
Fourth, crypto. Institutional access headlines like the Charles Schwab announcement mattered structurally, but immediate price formation was dominated by security incidents and liquidity stress. So, long-term adoption versus short-term fragility.
Fifth, large corporate and real estate financings kept deal flow visible. Convene secured $230 million in financing, and there was a $225 million industrial build announced. Signals that capital is still flowing to select real estate subsectors.
Sixth, corporate finance noise. Intel announced about $14.2 billion in repurchases tied to its capital deployment story. That kind of buyback shows active capital allocation even as tariff and macro risks swirl.
And in finance regulation, Coinbase received conditional approval from the national regulator handling custody functions and broader regulatory chatter. The consumer watchdog staffing and enforcement items, plus disgorgement orders in the crypto world, increased uncertainty in parts of financials.
All of that makes regulatory outcomes an asymmetric risk driver. Approvals can open distribution, enforcement can hit revenues unexpectedly.
Let's shift to cross-sector themes for a minute. There were about 4 big correlations we saw play out.
First, geopolitics and commodities drove sector rotation. Energy and materials benefited, while energy-intensive sectors took a hit. Second, policy normalization in cannabis and some healthcare cues suggested that regulatory clarity could unlock capital. But outcomes were binary and timing dependent.
Third, AI was everywhere but noisy, driving growth expectations while inviting privacy and data sourcing scrutiny. Fourth, liquidity and security issues dominated crypto, especially around holidays when markets were closed and miner activity picked up.
A short reaction segment.
AI is growth, with strings attached.
Liquidity still rules crypto.
Let's talk actionable insights. For informational purposes only, not personal advice. First, reassess commodity exposure. Scenario test models for oil between $100 and $120 a barrel and see which names are exposed to margin hits or tailwinds.
Yeah, and second, distinguish AI winners from the noise. Look for names where AI is scalable, high margin, and where firms have explicit plans for data governance and energy efficiency. That's where durability lives.
Third, with crypto, watch liquidity indicators, not just sound bites. Stablecoin flows, miner balance sheets, and custody assurances were the higher frequency indicators over the weekend.
Fourth, be selective in retail. Surcharges and higher logistics costs were creating margin pressure. Focus on pricing power and supply chain visibility, and monitor category signals like footwear that were soft.
Fifth, treat tariff changes as near-term margin risk. Look for commentary and earnings calls early next week. Companies will start to disclose the impact on cost of goods and guidance if they're exposed.
And finally, separate policy headlines from execution realities in cannabis and healthcare. Policy progress can unlock capital, but execution and compliance determine winners and losers.
Okay, some risks and what to watch next week. Geopolitical escalation around shipping lanes could rapidly reprice energy and insurance costs. Tariff implementation starts to bite early next week. Crypto custody and miner updates will tell us whether liquidity stress is easing. And federal policy items on cannabis and Medicare Advantage could create binary moves in narrow corners of the market.
Earnings and corporate guidance are also on the calendar. Expect companies in tech, materials, and industrials to use April calls to update guidance, And watch for buyback or capex changes that alter free cash flow expectations.
Before we wrap, a tiny bit of color on headlines that got called out specifically. Amazon's seller surcharge of 3.5%. Convenes $230 million financing. The $225 million industrial project. And Intel's repurchase program of about $14.2 billion.
And don't forget the exchange and custody angle. Conditional approval for custody services was a notable regulatory development for a crypto-adjacent platform during the holiday.
We should also remind listeners about the big picture takeaway. Leadership looked rotationary. Commodity-sensitive and project-driven sectors got flows, while speculative and liquidity-sensitive areas were more vulnerable. AI remained a structural theme, but also a source of headline volatility.
Short reaction.
Rotation, not a single-factor rally.
Volatility around policy and geopolitics.
All right, quick reminder on our framing. This is informational only. We didn't recommend buying, selling, or holding any specific security. Analyst note, data suggests, momentum indicates. Those are the ways we're describing market sentiment, not prescriptions.
Final takeaways in a nutshell. Energy and materials showed the clearest upside signals, supported by higher oil and project finance. Crypto stayed fragile despite institutional access headlines. AI kept tech headlines buzzing, but with compliance and data risks. Consumer and parts of finance were dealing with margin pressure from fees and tariff risk. And watch tariffs, geopolitics, and policy news next week for outsized sector moves.
That's a great summary. If you want more detail or a follow-up on any of these threads, head to stockalpha.ai and drop us a question. We'll answer live in the Q&A. For more market analysis and insights, visit stockalpha.ai.
Thanks for listening. We'll be back after next week's headlines to break down what actually moved markets and why. See you then.
Take care, everyone. And remember, if you have questions about anything we covered today, head to stockalpha.ai, where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai.